Hello, my name is Tiffanie and welcome back to my channel, or welcome if you are new. Today we are going to talk about investment strategies. My face is a bit swollen today. I had my wisdom teeth removed a few days ago and it's still healing. Let's dive into this video. First thing that I wanted to say is that there are two types of investments or investors. You have a passive investor and then you have an active one. I'm more leaning towards the passive investor side. It's also important, I'm not a financial advisor, so none of this is financial advice. It's just me, a girl on YouTube who is investing for like 2-ish years now, and I want to share the little knowledge that I have. Okay, we are going to the passive investor side first, which is, I feel like, also divided into two parts. You have the buy and the hold investors who just have a lump sum of money and are putting it all in one chunk in the stock market, either in one ETFs or a few ETFs. And we have the other side, who is more of the dollar cost averaging side. Which is basically you don't have the lump sum, but you have a regular income, and you take a bit of that income and put it into investments every month or every 2 weeks or every week or whatever you getting paid. And that way you are growing your investments over time. Not sure which one is best. There has been a time when I was just the buy and the hold, just a big lump sum. And there are other times that I was investing every month, just when my paycheck hits my account. So I have been in two camps. It's kind of depending on your personal situation. I feel like as long as you are having something in investments that it's already working for you, I'm not gonna push anyone to invest every month if you have other things that you need to be paying first. In the ETF world, I guess, you have two types of ETFs. You have accumulating ETFs, which is basically ETFs that hold their value and grow within their own value. And you have ETFs that pay dividends. And when they pay dividends, they don't grow as fast because they will have to pay the holders. In Belgium, if you make a profit on dividends, 30% has to go to taxes, and I feel like that's a lot. So that's why I didn't want too much of a dividend paying ETF. Okay, so while I was doing my research for this video, I came across 6 types of investing, and types are from safest to riskiest. So we are going to start with the safest one, and I think that's based on my research. The safest one would just be a broad market index, like a world ETF, and just put all of the money in the world ETF. It won't grow as fast, but it won't have this massive downfall normally. So you stay kind of consistent with the growth, which is nice. It's why I have now 60% of my ETFs in a world ETF. The second strategy is a dividend ETF strategy. It's basically that you just buy dividends, paying ETFs, and just live off the dividends. After a while, few years, few decades, they grow. Like the value of the ETF grows not as fast, but you will get the money in return every year or every quarter, every month, depending on the ETF. Right now, my portfolio has around 10% of a dividends paying ETF, because I wanted to try it out. Mine is based in Europe. I am from Europe, so I have a strong connection there. I feel like when you are still building your investments, it's better to have accumulating ETFs, so that the value gets reimbursed within the ETF, so it grows faster. I feel like that's a very good option, and maybe then when you have like saved enough, you waited enough, that you can kind of change strategies a little bit. I feel like people are very anti changing strategies, but I feel like if you have different like if you have different parts of life, then you can change it up a little bit depending on what you need at the time. Okay, the third option is that you spread your portfolio yourself to different sectors or different continents. That you want to have some world ETFs, some specifically to a sector or specifically to a market. I stay away from emerging markets most of the time. I feel like in my world ETF there is a little bit of emerging markets, but I don't know enough about these markets to invest in them. I'm not very, like, I just don't know. So I invest in what I trust. When you are spreading to different continents, you will have to know that some of the ETFs are in a different currency. That currency fluctuates, and that it will show in your investments. So I'm European, my currency is the euro, and I would advise to another European that you stay within the euro. With a lot of ETFs are in the dollar, the American dollar. Yeah, it's difficult to find them in euro, but they do exist, so you should look into that. I do believe in a good spread out. I like a good spread out. I don't want everything in a world ETF because I feel like I'm quite young. I want to have some of that growth. Basically, that's why I'm still investing in technology and stuff like that. Okay, so the fourth one is the sector ETF rotation investments. So I feel like this is the moment that we are going from a passive approach to a more of an active approach. So you will choose the sectors based on the economy circle, because usually the economy, what comes around goes around. You will have different cycles, and depending on where you were globally in that cycle, you can make a decision. My knowledge of economics is very, very basic, so I'm not gonna deal with that. But you should have different things when there is this recession, and different things when there is growth and stuff like that. On my own, because I was so invested in tech, that when that dropped, I was thinking about other ways to hold value, and that's when I was starting to get into gold to balance those two out. And then later on, I definitely took a chance on the gold ETF, and now I feel more comfortable with the gold ETF. But I still have both technology and gold to balance each other out. The fifth one I also don't understand is the covered call income, which is basically like an ETF that has dividends, but the focus is so much on the dividend part instead of the growing part that I'm feeling a bit shaky about it. I feel like it's a bit too good to be true. These have yields, so yield is like the percentage that they would pay you out of, like 10 or 12%. It's crazy. Usually the yield is like a lot less, like 3%, 2%. I think those two are very well, are already good. You have from 1% to with like 10 to 12%. That's a lot, and I don't know how that would work in the long run if you make such slow progress overall. I don't know. I also feel like that once you would look into it, it's not gonna be all that great because it feels too good to be true. But you could look into it. If you know more about these type of ETFs, you can let me know in the comments. The same with the sixth one. So the sixth one is the leveraged ETF. Grows with 1%. And with the leveraged ETF, it goes plus 2% or plus 3%. And I think it's more about like a day trading thing. that you really think about this ETF in particular. Will this ETF grow today, or will it fall down today? And you kind of want to hop in on one of those. So you have this massive ups and this massive downs, and I feel like it can really destroy your portfolio in a very short amount of time. I just stay away from day trading or any form of like day trading or swing trading, like options and stuff like that. I just stay away from it. I mean, like swinging with options, I feel like it's not as bad as day trading with leveraged ETFs, but it's too active for me. And okay, that was it. It's a bit of a shorter video because I just have my strategy and I don't know much about all of the other strategies, but I wanted to give you guys some basis to look into. If I can improve on anything, you can let me know below. Thank you all for watching. Bye bye.